Greetings, members, one and all of the Salivation Nation. The ultra wealthy around the world are going for gold amid a stimulus bonanza. Let's explore. In an article that comes to us from Reuters, in some ways it shouldn't come as a surprise that many rich folks are accumulating gold. There's really nothing new to this, but I think this does give us a bit more confidence that we're doing the right thing for those of us that are not in those income brackets. As stock markets roar back from the coronavirus-led rout, advisors to the world's wealthy are urging them to hold more gold, questioning the strength of the rally and the long-term impact of global central banks' cash splurge. Before the COVID-19 pandemic, most private banks recommended their clients hold none or just a tiny amount of gold. Now some are channeling up to 10% of their clients' portfolios into the yellow metal as a massive central bank stimulus reduces bond yields, making non-yielding gold more attractive and raises the risk of inflation that would devalue other assets and currencies. Well, not only that, but some have said as much as 35% should be spent into gold for those in those income levels. While gold prices have already risen 14% since the start of the year to $1,730 an ounce, many private bankers bet that gold, a hedge for both inflation and deflation, which is very important, which is why I talk about gold as being a hedge against economic instability as opposed to being a hedge against inflation. It has further to run. Our view is that the weight of monetary supply expansion is going to ultimately be debasing to the dollar, and the Fed commitments, which are anchoring real rates, make the case for gold pretty sturdy, said Lisa Shallett, Chief Investment Officer with Wealth Management at Morgan Stanley. And keep in mind, too, that before COVID, there was these repurchase agreements that the Federal Reserve had been injecting for these short-term loans between these big banks. 9 private banks spoken to by Reuters, which collectively oversee around $6 trillion in assets for the world's ultra-rich, said they had advised clients to increase their allocation to gold. Of them, 4 provided forecasts, and all saw prices ending this year higher than they are now. UBS, the world's biggest wealth manager, said gold could hit $1,800 by year end, and it's a base case scenario driven by ultra-low interest rates and investors seeking gold to hedge their portfolios, or even touch a record high of $2,000 in the event of a second wave of novel coronavirus infections. With the recent equity rally, people have become more nervous. People are actively seeking out portfolio hedges that might perform well in a range of scenarios, said Kiran Ganesh from UBS's Chief Investment Office. Morgan Stanley added a 5% position to commodities, including gold, in all its models to the end of March. While the bank was unlikely to advise a position above 10% in commodities like gold, Shallett said it could get there, especially if inflation picks up materially. The boost in demand could be a self-fulfilling prophecy for the metal's price, as any shift in allocation from bond and equity markets, estimated at up to a combined $200 trillion, has a much higher impact on the smaller gold market, estimated at less than $5 trillion. So there you go. People are concerned about the where the dollar is going and where their assets and like. And here we can see the global market asset performance measured from the year to the date and the quarter to date. We can see FANG stocks are performing in the positive direction. Both gold is in a positive direction for both, especially year to date, 13.6% increase. 7.1% increase from year to date. But look at U.S. Treasuries from quarter to date; they're in the negative. When the 10-year Treasury yield has been 13.3% on the year to date. But looking down through all of these assets, we get down to only to the S&P 500 for the quarter to date that has performed better than gold. And then we see here as well that Japan Nikkei 225 has performed a little better. MSCI developed equities for just the quarter has performed better. And other things here, the Eurozone stocks is better, but you look down here at the Brent crude oil from the quarter to date, it is up 80.1% because of the big drop that we saw before, down to negative 30 some odd dollars. And of course, we see here negative 37.9 in the year to date. Performance has been horrible. While some queries about gold have increased, very few clients had demanded a wholesale move into gold, something they would have been advised against, the bankster said, adding older clients tended to be the most concerned about inflation risks. That cohort is very concerned about wealth preservation. And in many ways, they have a longer historic lens than some of our other clients. So they do worry about inflation, Morgan Stanley's Shallot said. John LaForge, head of real asset strategy at Wells Fargo Investment Institute, said from two calls a week on gold last year, he is now at 2 calls a day, spiking at 10 calls when the metal has a good day. I'm now getting as many questions on gold as I do on oil, which says a lot from my perspective. Most people are interested in renewables and oil and so on, and gold was often considered a relic, Ford said. This could be the beginning of something new. We'll explain that momentarily. Well, not new, but revisiting something that we haven't seen in quite a while, which could be good for silver as well. Despite the fact that holding gold pays no income, Oliver Gregson, head of the United Kingdom and Ireland at JP Morgan Private Bank, said inquiries had gone up as clients increasingly viewed it as a port in a storm. He forecast a 1750 year-end price target. For those looking to hedge their bets with a shift to gold, the choices can be split into 4. Gold mining companies, index funds, which represent shares of real gold or track the price of gold, derivatives such as options and futures, and gold itself in the form of bar or coin. That's the one I recommend. Might as well get the physical. For hedging purposes, the first 3 are fine. If worries run deeper, investors normally opt for physical. But you think about it, if people do get into the mining stocks, index funds, ETFs, and the like, that's going to cause the price to go up because increased demand and like. Most of the larger banks offer a gold bar storage service, and 8 of those questioned by Reuters said they had seen an uptick in demand. So we're already starting to see this happen, particularly in locations such as Switzerland and Singapore. Andre Portelli, co-head of the investment at Barclays Private Bank, said while some clients had already begun adding physical gold in early 2020 as the COVID-19 spread, the trend had continued. A supply disruption in physical gold in March and April due to the closure of major gold bar manufacturers and lack of international shipping capacity fueled also additional client interest. So there you go. So this is interesting indeed, and it just goes to show you increased interest in gold by the wealthy is akin to essentially what central banks and nations around the world are doing, and that is stocking up on gold, which means the price will go up, which means that it's going to spark interest from others in lower income brackets to want to accumulate the yellow metal. But also, and even more importantly, this could trigger a run on silver, because as gold gets more expensive, silver becomes the commodity to get, and you can get, ounces and ounces of silver and feel like you have something of value, and as such, as opposed to getting, grams of gold or 1/10 ounce or a 1/4 ounce at a time. So I think that is going to possibly spark a resurgence in silver as well. But nonetheless, this is probably going to take a little while for it to really manifest itself. But we are seeing it, and this is fascinating news indeed. And this just goes to show you that people are nervous out there about where things are going with the economy. For you and I, we continue to stack no matter what, and good times and bad. And I think that is something steady as she goes. You accumulate more when it's cheaper and less when it's more. And you have that as your insurance policy, your hedge. So let me know what you think in the comment section below. I want to thank you all for taking the time to watch A Multitude of Gratitude. And reminder that I do post videos on a daily basis if you don't get reminders, either by notifications and or on your subscription feeds. You can always bookmark the channel itself and come back and see the videos posted there. It has been a known glitch with YouTube, has not been publishing some videos on the subscription feed, and we know there's a continuing problem with the notifications. So a multitude of gratitude to you all, and I want to encourage you to please rate, share, comment, and subscribe.